His Excellency, representatives of His Highness, the Emir of Kuwait, Deputy Prime Minister and Minister of Foreign Affairs, Sheikh Sabah Al-Khaled Al-Sabah, His Excellency, Deputy Prime Minister and Minister of Finance, Mr. Anas Al-Saleh, Her Excellency, Madame Christine Lagarde, Managing Director of the International Monetary Fund, His Excellency, the Governor of the Central Bank of Kuwait, Dr. Mohammed Al-Hashel, Ministers, Governors, ladies and gentlemen, a very good morning to everyone here. My name is Axel Threlfall, Editor-at-Large for Reuters. I am delighted to be here at the kind invitation of the Central Bank. It is my job to guide us through the day, to keep us on track, if you like. This is my first visit to Kuwait, and it's a great pleasure to see so many familiar faces, both from Davos and indeed from a number of other recent high-profile events in the region. On behalf of the Central Bank of Kuwait, the International Monetary Fund, and the Kuwait Center for Economics and Finance, I'd like to welcome you all to this high-level conference entitled Islamic Finance Meeting Global Aspirations. Its aim to foster a compelling dialogue around the sustained growth of the Islamic finance industry among the extremely impressive list of policymakers, regulators, Islamic standard setters, and actors from both the public and private sectors gathered here in Kuwait City today. Before I introduce our keynote speakers, do allow me a few brief words to set the scene. Growth of the Islamic banking segment has been fast and it has been widespread. Although still a small share of global financial assets, the segment has become systemic in at least a dozen countries, with clear implications for macroeconomic and for financial stability. It is a sector whose potential benefits generate much discussion and debate. At the Global Islamic Summit in Dubai last month, Nobel laureate Muhammad Yunus spoke passionately about how the sector can foster greater financial inclusion and how its emphasis on asset-backed financing and risk-sharing gives it the potential to provide valuable support to small and medium-sized enterprises. Two subjects we will discuss today. The potential for this market is clearly huge. The potential for the sector to grow at a breakneck speed is also huge. The question must be how this potential can be realized and how quickly. Growth in the sector is not without its challenges. The International Monetary Fund, in a report released back in April, endorsed the sector's principles as being able to, quote, help promote better risk management by both financial institutions and their customers, as well as discourage credit booms. But the endorsement did come with a warning that there were worrying differences in regulators' handling of Islamic finance, particularly where the industry was relatively young. No doubt we'll hear more of the IMF's thinking and indeed the increasingly involved role that it seems to be playing in the sector from the fund's managing director in just a moment. We have a very busy and fascinating day of discussions planned. The plenary, which will begin in a moment, will be followed by 3 discussion sessions made up of an extremely impressive lineup of speakers. On financial inclusion from 10:15 to 11:45, regulation and supervision 11:45 to 1:15, and a final session after lunch on developing sukuk and other long-term Islamic financing. We have simultaneous interpretation services available, channel 1 for Arabic, 2 for English, and 3 for French. I wish you all an extremely fruitful day, and hope the program helps not just with your understanding of the issues at hand, but also helps move the discussion of how to grow the Islamic finance sector in a safe and sustainable fashion forward. It gives me great pleasure now to introduce the first of our 2 keynote speakers, His Excellency Dr. Mohammed Al-Hashel, Governor of the Central Bank of Kuwait.
بسم الله الرحمن الرحيم. الحمد لله رب العالمين، والصلاة والسلام على أشرف المرسلين سيدنا محمد وعلى آله وصحبه أجمعين. معالي الأخ الفاضل الشيخ صباح الخالد الحمد الصباح، رئيس مجلس الوزراء بالإنابة ووزير الخارجية. معالي الأخ الفاضل أنس خالد الصالح، نائب رئيس مجلس الوزراء ووزير المالية. معالي السيدة كريستين لاغارد، مدير عام صندوق النقد الدولي. أصحاب المعالي والسعادة، الحضور الكرام، السلام عليكم ورحمة الله وبركاته. يشرفني بداية أن أرفع لمقام حضرة صاحب السمو أمير البلاد الشيخ صباح الأحمد الجابر الصباح حفظه الله ورعاه أسمى آيات العرفان والامتنان على دعمه الدائم لبنك الكويت المركزي ورعايته السامية للمؤتمر العالمي للتمويل الإسلامي الذي ينظمه بنك الكويت المركزي بالتعاون مع صندوق النقد الدولي. ويسرني أن أتقدم بخالص الشكر والتقدير لممثل صاحب السمو الأمير معالي الأخ الشيخ صباح الخالد الحمد الصباح، رئيس مجلس الوزراء بالإنابة ووزير الخارجية. كما أود أن أوجه خالص الشكر والتقدير إلى معالي الأخ أنس خالد الصالح، نائب رئيس مجلس الوزراء ووزير المالية، على دعمه المستمر ومشاركته معنا في فعاليات هذا الملتقى المتميز. Your Excellencies, distinguished guests, ladies and gentlemen, good morning. It is a great pleasure for me to welcome you all. I'm deeply indebted to all the honorable ministers and governors of central banks and other distinguished guests for joining us today on this auspicious occasion. In particular, I'd like to warmly welcome and thank Madame Christine Lagarde, Managing Director of the International Monetary Fund, for graciously supporting this endeavor and personally attending this conference. I would also like to sincerely thank the staff of the IMF, the staff of the Center for Economics and Finance in Kuwait, and my dedicated colleagues at the Central Bank of Kuwait for their efforts in making this conference a success. It is the first time that the IMF is co-hosting a conference on Islamic finance such as this. And the Central Bank of Kuwait is privileged to be a partner in organizing this historical event. Taking this opportunity, I would like to share a few thoughts on the progress of Islamic finance in a historical context. My speech is set against 3 different times, covering the past, the present, and the future. I will start with a very brief history of Islamic finance, particularly in the context of Kuwait, then turn to cover the present, and finally reflect upon its future. This broad sweep through history will hopefully help us see where we started from, how far we have reached, and where we are heading next. Let me start with the past. Around 38 years ago, in the same city as we are meeting today, a pioneer, Sheikh Ahmed al-Yassin, envisioned the possibility of establishing an Islamic bank. Back in the mid-1970s, many would have considered it mere daydreaming. After all, there was hardly any role model of Islamic finance to emulate. In the words of Sheikh al-Yassin himself, thinking of establishing an Islamic bank was like swimming against the tide. It was a time when only conventional banks were in vogue. We ourselves had 6 of them in Kuwait. So it required a big leap of faith to establish an Islamic bank when there was virtually no example to learn from. Despite these challenges, Kuwait witnessed the establishment of Kuwait Finance House, KFH, not only the first Islamic bank in Kuwait, but also one of the very first established anywhere in the world. It was a humble start. With only 4 employees, KFH opened its door to the public for the first time on August 31st, 1978. I doubt anyone imagined that it would one day become a leading Islamic bank with 8,000 employees and operations spanning across 7 regions of the world. The growth of Islamic finance as an industry is equally impressive. This is, however, hardly surprising, as the basic principles of Islamic finance deservedly have a universal appeal, irrespective of religious beliefs. Adam Smith, the father of modern economics, argued that it is the pursuit of self-interest by individuals that leads, somewhat unintentionally, to the welfare of a society as a whole. Islamic teachings, however, offer a more encompassing guide by making the broader interests of a society central to our efforts. 14 centuries ago, the Prophet Muhammad, peace be upon him, said, أحب للناس ما تحب لنفسك. Wish for mankind that what you wish for yourself. This is the golden rule of a good society, a principle that has been conveyed by almost every major religion and ethical tradition. It goes beyond Adam Smith's idea of the invisible hand, in the sense that society's welfare is not an accidental outcome. Rather, the golden rule requires that anything that harms a society is prohibited, even if it's beneficial for an individual. And the golden rule epitomizes the concept of justice, which is central to Islamic finance. Justice in economic context requires at least 2 things: proper allocation of resources for the welfare of the entire society, and sharing of risk and reward. Since banks mobilize savings from a large group of people and lend to relatively fewer borrowers, there is an element of asymmetry in banks' resource mobilization on the one hand and resource allocation on the other. This necessitates that banks, in the world of Islamic finance, lend to those who can use these savings to benefit the whole of society by making productive investments and creating more jobs. However, in recent years, excessive liquidity amid unconventional monetary policies has mostly fueled asset growth, with limited impact on real economic activity. As Madame Lagarde rightly pointed out in one of her speeches last year, there is too little economic risk-taking and too much financial risk-taking. Islamic finance, by establishing an inseparable link between finance and real economy, encourages economic risk-taking that helps improve growth and create jobs. It requires that credit must be provided for productive investments, not for conspicuous consumption or speculative activities. And such a business philosophy makes perfect sense, regardless of religious beliefs. Warren Buffett, the legendary investor of our time, was once quoted in Fortune magazine comparing 3 types of investments. First, currency-based investments, which he considered the most dangerous, though investors mostly consider them safe. Second, investments in assets like gold that never produced anything. Yet he favored the third type, investments in productive assets, whether businesses, farms, or real estate. And this is precisely what Islamic finance also requires banks to do, to promote investments in productive assets, so that the entire society can benefit. More importantly, Islamic finance goes a step further, as it also requires the sharing of profits and losses. That is not only important from the justice standpoint, but also to ensure financial stability. Lenders would have the incentive to monitor the quality of investments being made if they have to share risks and rewards. Therefore, Islamic finance, in its true spirit, not only curbs speculative activities, but also discourages excessive risk-taking. Moreover, it promotes the kind of economic risk-taking which benefits all of society, not just affluent investors. Let me now turn to the present state of Islamic finance. From the establishment of the first Islamic bank in Kuwait, around 4 decades ago, we now have 5 domestic Islamic banks that collectively account for 39% of domestic banking assets. This is the 3rd highest share of Islamic banks operating in any country, with a dual banking system where conventional and Islamic banks operate in parallel. Globally, Kuwait has the 5th largest share of Islamic banking assets and the 3rd largest share of Islamic funds. And it's not only in Kuwait that the Islamic finance industry has taken off in recent decades. Estimates suggest that the global market for Islamic financial services, as measured by Sharia-compliant assets, has crossed $2 trillion by now, a quantum leap from $150 billion in the mid-1990s. Last year, the Sukuk market witnessed debut issuances from governments of 4 non-OIC countries: the UK, Hong Kong, Luxembourg, and South Africa, which indicates the growing popularity of Sukuk beyond the Muslim world. As these trends highlight, Islamic finance is neither a novelty nor is it restricted to Muslim countries only. Over the past decade, the industry has transformed itself from being a niche market to a viable alternative for consumers of conventional finance, irrespective of their religious beliefs. Today, Islamic banks serve millions of customers across the Middle East, Southeast Asia, and beyond, offering a variety of Sharia-compliant products and services. While it is indeed a remarkable achievement, Islamic finance has significant potential for further growth. Let me very briefly point out 3 such areas. First, both within Asia and MENA, the regions where Islamic finance has a greater footprint, there is substantial scope for investments in infrastructure. Amid the growing populations in some countries and mass urbanization in others, the needs for modern infrastructure are immense, ranging from airports to power plants and dams to highways. These investments are invariably backed by tangible real assets, and thus ideal candidates for Islamic finance. Second, the world is increasingly recognizing the importance of investments that are socially responsible and environmentally sustainable. And given the similarity in their business philosophies, Islamic finance can be a natural choice for socially responsible investments. Third, in many developing countries, a majority of the public still remains hugely underserved by a formal financial system, if not entirely unbanked. For instance, World Bank data on financial inclusion for 2015 reveals that only of the adult, 45% of the adult population has a bank account in South Asia, 45.5%, and merely 14% in the MENA region. Incidentally, these 2 regions are home to more than 1.3 billion Muslims, around 82% of the entire Muslim population. These numbers collectively highlight that Islamic banks have the potential to reach millions of underserved or unserved customers. A banking model inspired by the philosophy of social justice can ill afford to ignore its responsibility in serving the millions, which are otherwise possibly at the mercy of exploitative, informal moneylenders. Let me now turn to the future. Niels Bohr, Nobel laureate in physics, said a century ago, prediction is very difficult, especially if it is about the future. And may I add, prediction is even more difficult if it is about the future of finance. So instead of attempting to predict the future, I would like to discuss what needs to be done to help the Islamic finance industry reach its potential. In this regard, the role of 4 types of institutions is critical, not only in providing an enabling environment for a sustainable and a resilient industry, but also in bringing current practices closer to the true spirit of Islamic finance. First, consider the legal institutions, which offer the necessary infrastructure that, among other things, helps protect property rights and enforce contracts. Hernando de Soto, a Peruvian economist, emphatically wrote about the countries with poor legal infrastructure, arguing that the majority of entrepreneurs are stuck in poverty, where their assets adding up to more than 10 trillion US dollars languish as dead capital in the shadows of the law. He contended that in the absence of effective legal institutions, inhabitants of such countries are just custodians of dead capital. And that because, while they may own plenty of resources, either they cannot prove legal ownership or they cannot efficiently use them in various transactions, given the inadequacy of legal institutions. Both for their social and economic implications, Islamic principles lay great emphasis on honoring obligations and fulfilling commitments. The Holy Quran specifically exhorts us by saying, يا أيها الذين آمنوا أوفوا بالعقود. O believers, fulfill your obligations. Strong institutions ensure it does happen by protecting property rights, enforcing contracts, and thus helping reinforce mutual trust in societies. Second, take the role of academic institutions. Muslim societies were once recognized for their contribution to various academic disciplines, ranging from alchemy to astronomy and mathematics to medicine. Today, the scholarly work being produced in our societies is more of an individual effort than anything at the institutional level. Due to this lack of capacity building at the institutional level, efforts of otherwise dedicated individuals have remained divergent and fragmented. Many with profound knowledge of Islamic jurisprudence, al-fiqh, know little about modern finance. And our experts on conventional finance in general are inadequately equipped to understand the implications of various Sharia injunctions. A study reveals that the top 10 scholars in Islamic finance account for 67% of all chairman positions of Sharia boards. No wonder that Islamic banks struggle to find candidates for their Sharia boards who can suitably guide them in offering innovative products. Third, consider the regulatory institutions. Effective regulation of Islamic finance is a daunting task, particularly in a dual banking system. Additionally, the peculiar nature of Islamic finance poses its own challenges in terms of designing a robust regulatory regime. Take the case of Basel III reforms, for example, where detailed guidance has been provided by the Basel Committee for Banking Supervision, BCBS, for the implementation in a conventional setting. However, for Islamic financial institutions, limited relevant guidance is available, if at all. This undoubtedly requires the use of discretion by respective regulators. But the greater use of discretion is bound to create differences across countries and may increase the risk of regulatory arbitrage. Yet importantly, such reforms were meant to foster a high level of convergence among regulatory regimes. Fourth, high responsibility also falls on Islamic financial institutions to make efforts in offering products and services that reflect the spirit of Islamic finance and are not just merely compliant with Sharia requirements. This requires building capacity to do better research and offer innovative services. Moreover, Islamic financial institutions need to operate with the aim of promoting social justice in their allocation of resources. Given these challenges, it is not possible for any one of these four types of institutions to make a meaningful difference on its own. Each institution, from academic to regulatory and legal to financial, has a distinct yet mutually reinforcing role to play. While individually insufficient, collectively, these institutions provide the very foundation for a dynamic and resilient Islamic finance industry, and are thus the prerequisites for its sustainable growth. Finally, allow me to share a few concluding thoughts. Current economic and financial trends are a constant reminder that the world needs a better system. The inherent fragility of modern finance is quite evident. And in recent years, the unfolding of events like manipulating currencies, rigging LIBOR, and mis-selling mortgages has intensified the debate about the role of incentive structures and ethics. Amid the growing concerns about excessive risk-taking and ethical drift, Islamic finance can play a role by offering a financial system based on strong underlying principles. A system which, if implemented in its true spirit, will bolster growth, create jobs, reduce poverty, and address inequality. A system which will channel credit into productive investments, not into speculative activities or wasteful consumption. And a system which will promote investments that are socially responsible and environmentally sustainable. However, for such a system to deliver, we must shift our focus from Sharia-compliant model to a Sharia-based model. Compliance is easy and can possibly be achieved without reforming institutions. But ensuring a Sharia-based financial system will require fundamental changes, not only in the finance industry, but also in the very way our societies function. And that is why building institutional capacity is of paramount importance. Undoubtedly, it is an uphill task, but not an impossible one. And collectively, we surely can. As Tagore once wrote, you cannot cross the sea by merely standing and staring at the water. All of us need to play our part in achieving that enviable goal, the goal of putting together a system that is ethically right, socially just, financially stable, and economically productive. Thank you very much.